Well, good afternoon, everyone. I'm Professor Deborah Healy from the UNSW Faculty of Law and Justice, and I'm co-director of UNSW Law's Herbert Smith Freehills CIBEL Centre, and I am delighted to welcome you to the first panel of the CIBEL-CCLA Banking Law Webinar. I would like to begin by acknowledging the traditional custodians of the lands on which we meet today, and I would also like to pay my respects to the elders, both past, present and emerging. I will introduce each panellist before they speak, and our format is that our panellists will each speak for somewhere around 10 to 15 minutes before we open up for questions. And I'm looking forward to hearing what all of our speakers have to say about this interesting issue of digital bank and digital currencies, a new world of banking and money, and challenges for CBDCs, stablecoins and digital payments in the Asia Pacific. And we're delighted that so many of you have decided to join the webinar. So our first speaker is Scientia Professor Ross Buckley, who is a member of the Herbert Smith Freehills CIBEL Centre. He was appointed a Scientia Professor and to the CIFA King and Wood Mallesons Chair in International Financial Law in 2013. His principal area of research interest is in regulatory measures to increase the resilience and stabilities of financial systems, and he has written a substantial number of publications exploring how China might more effectively participate in international global governance. His present focus is on regulation of digital financial services in a range of jurisdictions, including China. And he's currently in the middle of a 3-year research project funded by the ARC, which looks at these issues. Ross's topic today is systemic challenges and systemic risks associated with CBDCs and stablecoins in the Asia Pacific. So we will now listen to Ross. Thank you.
Good afternoon. I wish I could be there with you in person, but I am flying right now. So I've pre-recorded this session. I'm going to speak with you about systemic challenges and risks of central bank digital currencies and stablecoins in the Asia Pacific. So let's get into it. What are central bank digital currencies? How do they differ from the currencies you deal with? Well, these days, whenever you deal with money, it's commercial bank money. When you get paid, when you pay your mortgage, when you pay for your meal at the restaurant, you're using payments that come off the account of your account at a commercial bank or receiving payments from a commercial bank. Commercial banks have central bank money. You typically don't, except to the extent that you use cash. The only central bank promise you deal with is that embodied in cash. A central bank digital currency changes all that. It's the same currency, so a digital euro, a digital US dollar, a digital renminbi, but it's issued by the sovereign, directly by the sovereign. It is central bank money. A stable coin is something different again. It's a cryptocurrency, the value of which is tied to a stable currency, typically. So if Facebook proceeds with its Libra DM proposal, it will issue Libra coins, now called DM coins, which will be tied one-to-one to the US dollar or to local major currencies. So in that sense, the stable coins are cryptocurrency, but it's stable because of this being tied to the value of a fiat currency. So a stable coin is a cryptocurrency designed to overcome the problems of cryptocurrencies. You have a lot of choices if you're a central bank in designing a central bank digital currency. You can operate on a single centralized ledger or on a distributed ledger. Distributed ledgers primarily address trust problems, and central banks don't have trust problems. So expect to see these things running on centralized ledgers, and that's what Sweden is proposing to do. It's very well advanced. That's what China is doing with its DCEP, digital currency electronic payments, that it's now trialling in 4 major parts of China. That isn't running on a distributed ledger. Why would you do it? If you were a nation, why would you issue a central bank digital currency? Well, Sweden will do it probably within 2 years because cash is going out of use there. 2/3 of Swedish banks' branches today don't carry cash. Cash is just disappearing, and the central bank is uncomfortable with leaving payments in the economy, retail payments, up to Visa and MasterCard. They don't think these commercial for-profit entities will look after the poor, will look after the elderly, will look after the rurally remote. The central bank wants to be in the business of issuing the means of exchange. For 500 years, they've done that with cash. Going forward in Sweden, they'll do it with a digital currency. Another reason, and a major reason, a central bank would issue a digital currency is to respond to the threat posed by Libra or DM, the Facebook stablecoin. Another reason would be to support payments in a world where payments are increasingly going digital. A strong desire in China is the desire for more information and control. A central bank digital currency gives a country a lot of control over what its citizens spend money on. It could be disabled for an alcoholic vis-a-vis alcohol. They could be prohibited from using their currency from buying alcohol, just as an example. And it will give, in the China case, the central government a tremendous amount more information about what every Chinese citizen is spending their money on. The thing in Australia, I suspect, or in Canada or in other countries that will trigger the issuance of a CBDC is if and when China releases its DCEP for offshore use. Because if China's central bank digital currency can be used to pay for international trade, all of the information associated with that will end up in China, and the trading partner, Australia, Canada, or the US, won't be comfortable with that. So they'll need their own digital currency. Reasons for China to issue its digital currency electronic payment: surveillance and social control, the promotion of financial inclusion. There's still a lot of people in China who are unbanked in poor rural areas. It will help those people save money and make payments. A peculiarly Chinese motivation, I think, is that it wants to see the renminbi as a global reserve currency. The US gains enormous benefits out of minting the effective global reserve currency in the US dollar, and China wants some of those benefits for itself. To the extent DCEP can be modified to work really well in paperless trade documentation, and to the extent China will make it free, which I think they will because they're playing a different game, they're not playing a short-term profit game, then we could see a lot of international trade payment going through the renminbi sector. Another peculiarly Chinese motivation is to limit the incredible market power of WeChat and Alipay, which between them have over 90% of payments in China. And as we have seen with the Chinese regulators throwing their a wrench in the float for Alibaba, for Alipay, Ant Financial, the central government is interested in restraining the power of these corporate behemoths in China. What are the systemic risks? Well, this is the reason most central banks are hastening really slowly in this space. A central bank digital currency is a totally different structure. It won't look very different on the surface. Most people using it won't notice very many difference in their day-to-day payments from how they pay today. But the fact that it's a direct liability of the central bank changes a lot. And how I always like to think of it is Australia in 2008. The global financial crisis is underway. People were getting very nervous. I had a friend who his bank phoned him up and he put some money on deposit. They phoned him up a few days later and said, "Have you got any more money you'd like to put on deposit with us?" And that spooked him. He thought, why does the bank need my money? I think I want to get my money out of the bank. In that situation, one of the things that restrains a run on the banks is you've got to have somewhere to put it. But if the somewhere you have to put it is with an account in the central bank or somehow a liability of the central bank, you will run away from commercial banks in that extreme situation. You have re-architected the system to support the mother of all bank runs. So that's the main reason I think that central banks around the world are moving slowly on this. It's a different architecture. Central bankers are rightly cautious by nature. Their job demands they be cautious. We really need to think through how all this works in practice. And the people who have moved on, like the Chinese government, they've been researching this for 7 years. This is not a quick fix. Canada, the UK have each been working on it for 5 or 6 years at least. It's a big change. It needs to be researched very, very thoroughly. Now, just quickly on stablecoins. The risks and challenges of stablecoins are rather different. They are likely to take off, in my opinion, in emerging markets where the local currencies are not strong. Stablecoins should be able to reduce remittance costs. Remittance costs from Australia and New Zealand into the Pacific are some of the highest in the world, and a DM coin denominated in Australia dollars, although I don't think there's any plan for that at the moment, but if it was to come to pass, it would slash the remittance costs. Then it's easy to see if DM Libra is flowing into Pacific nations, people at the recipient end won't necessarily cash out of it. Merchants will accept it, it will start to circulate, it will become a parallel currency, and it has the potential to remove or replace the local currency. This reduces the policy space available to the local central bank. They can't reduce interest rates effectively to stimulate the economy. They can't impose capital controls to keep money in the island state at the time of crisis. They have less monetary sovereignty. This is one of the real risks for stable coins in our part of the world. In terms of China's Deepcep, as I've already said, I think China is already trialling this offshore in a very limited way. It won't take months, it will take years, but there will come a time when China, I think, is providing a very highly efficient, cheap, possibly free payment mechanism for international trade. At that point, if people don't want the data to end up in Shanghai and Beijing, they're going to need their own digital currency. It used to be you followed the money to work out what was going on. Increasingly in our modern world, you need to follow the data. The data associated with the digital currency used in the trade context is massive. And so I think ultimately the global trigger for countries that are hastening very slowly at the moment on this, like Australia, like Canada, like the US, the ultimate reason they will move to issue is because they have to compete with China in the international trade space. And as a concluding point, there's a lot of our research. You can click on the links if you are suffering from insomnia or otherwise need help going to sleep. Thank you very much. Pleasure to speak to you today.
Well, I'm sure you'll all agree that that was an extremely instructive brief chat from Ross, who is all over this topic and is researching thoroughly in it. The next speakers, we'll have questions at the end. For those of you who may want to have questions, you may start to leave them in the questions section of the webinar, and we will sort them, and our speakers will be able to answer them as we go, although not Ross, unfortunately. But our next speakers are Nydia Remelina Leon and Assistant Professor Kwan Ho Lau of Singapore Management University, Yong Pung Hao School of Law. Nydia is a research assistant at the SMU Centre for AI and Data Governance and an adjunct faculty at the university. Her main areas of work and academic research include financial regulation, capital markets and banking law, fintech, digital ethics, AI governance, and the intersection of law and technology. Nydia has been an instruction for the Global Certificate Program, jointly organised by Harvard Law School and IOSCO, and she's acted as a senior advisor to the OECD. Kwan Ho is the Deputy Director of the Centre for Commercial Law in Asia at the SMU Law School. He teaches and researches primarily on the law of contracts and private law. His other research interests include the legal process and development of the legal professions, and he's published in top-ranked journals and has been cited by courts. He practiced in corporate mergers and acquisitions in a major law firm in Singapore for a number of years, and as a Supreme Court Justice law clerk before going to SMU. So I hand you over to Nydia and Kwan Ho.
Thank you so much, Deborah, for the introduction. Kwan Ho and I are honored to be here sharing the panel with such an excellent group of experts in the field. We look forward to the discussion afterwards. We will discuss some of the challenges different to those associated with systemic risk already talked by or explained by Ross. We will talk about another challenges of central bank digital currencies, stablecoins, and digital payments, and we will focus on the Singaporean approach to some of those challenges, and we also will talk about the international recommendations on some of those challenges associated with digital payments, stablecoins, and central bank digital currencies. In the next slide, please. We can see the taxonomy of digital representations of money. This taxonomy is evolving. So even though we will focus the presentation on digital payments, central bank digital currencies, and stable coins, many people ask when we approach the topic on central bank digital currencies, why is this related to these other digital representations of money if the regulation is quite different to the one applicable to central banks, for example, and the one applicable to other payment service providers. Even though regulatory approaches are different and may be different, the functionality of these different digital representations of money is quite similar. So that's why some of the challenges are similar as well. And regulators need to think about similar approaches, but also take into account those differences of each one of those means of payment. We define here central bank digital currency as a digital representation of sovereign currency issued by and as a liability of a jurisdiction's central bank or other monetary authority. And this definition is consistent with what Ross just explained in his video. And we wanted to note that that's the definition that we also take when we talk about central bank digital currencies, because many scholars and central banks and issuers and digital payment service providers all over the world are also talking about other type of central bank digital currencies, the second group that we see in this slide, called synthetic central bank digital currencies. The synthetic central bank digital currencies are backed by, but not issued by or direct claim on a central bank, but can be deemed legal tender. These are included in some of the studies published already by the Bank for International Settlements as central bank digital currencies or as an alternative in the design of central bank digital currencies, but clearly they work differently because they are not issued necessarily or a direct claim on the central bank. So it's important to have in mind those differences. In the slide, we also see the digital payments that store e-money or other types of digital representations of money. These are the typical digital payment service providers, and stablecoins, particularly not the ones that don't use algorithms for stabilize the price of the stablecoin, and cryptocurrencies. These digital assets that serve functionally as means of payments. And in Singapore, for example, we call them legally, and in the legal taxonomy, they are called digital payment tokens. So that's the ecosystem and the taxonomy and how it has evolved in terms of digital payments. Some years ago, we only talked about electronic money, and most regulatory frameworks focused on regulating the issuers of electronic money. But as we've seen, the issuers of other representations of money in the digital space is evolving, and they are entering in the regulatory space. We will see in the next slide, please, the considerations and challenges different to those associated to systemic risk of central bank digital currencies in particular. Considerations, just to mention some of them, but Ross already mentioned financial inclusion, for example, but others could have more granular data for payments, not necessarily for surveillance and control, but for just to leverage applications on artificial intelligence, open banking, and this type of initiatives that are based on the flow of data in financial markets, and hence digital payments ecosystem with more competition in some countries as China, for example, as Ross mentioned. The central bank is interested in solving the problems associated with the concentration of digital payments markets. So that could be one of the motives behind the issuance of a central bank digital currency. Increase the efficiency, particularly for cross-border payments. That is the focus in Singapore. For example, the Monetary Authority of Singapore in Project UBIN was exploring the central bank digital currency as a tool to enhance the efficiency of cross-border payments. But some challenges are associated with the transmission of monetary policy, as Ross already mentioned, and many of the literature on central bank digital currencies point out. The fragmentation of the global monetary and financial system, actually one of the papers written by Ross and other authors already talk about this type of risk, but also some operational challenges. It's not something about the capacity, it's not only about the capacity of the central bank in order to handle the technology and have the technology to develop and deploy a use case for central bank digital currencies, but also other risks associated, for example, with interoperability and the architecture of the entire payment system. Cybersecurity is a major issue in this topic. Money laundering and financing terrorism, it's another issue, and actually the focus on most of the discussions of digital payments right now, especially in the space of digital assets such as central bank digital currencies, stablecoins, and cryptocurrencies or digital payment tokens, and some legal challenges as well. Constitutional law, banking law, tax law, accountancy, and payment systems regulation may be amended if a jurisdiction is interested in issuing central bank digital currencies. Some countries, you see in the slide, some countries that have already started the projects on developing use cases for central bank digital currencies, but the pilot that is probably most advanced is China. As well, in Uruguay and Bahamas, the central banks already have also a pilot well advanced in this regard. In the next slide, we will see some of the challenges associated to stablecoins. Are they the next step in digital payments? And probably this is a question that many regulators are asking right now because of the initiative that Ross already mentioned about DM Association, the initiative led by Facebook, basically. But not only because of that, also because particularly in 2020, stablecoins became very popular because of what happened in financial markets in March. Many users of stablecoins felt the need to go to the markets on stablecoins in order to to stabilize the price and make less riskier this type of investments. Additionally, money laundering issues are becoming a major thing in stablecoins because before the conversations on stablecoins, the Financial Action Task Force since 2014 focused the conversation and the debate around preventing money laundering in the space of within frameworks applicable to virtual asset service providers understood as these providers that facilitate transactions in the space. So basically wallet providers that act as a custodian and cryptocurrency exchanges, for example. But now the conversation is kind of changing because the issuer of a stablecoin could be also responsible according to the last consultation paper, the consultation guidance just issued a couple of months ago by the Financial Action Task Force. The issuer of a stablecoin, if they govern the platform that stabilizes the price, could be also responsible in terms of money laundering. But also other pending issues that go beyond money laundering and preventing this type of risks is also associated with the stablecoins, particularly those issues related to consumer protection. It's known for the market that in 2019, Tether Limited officials confirmed that only 74% of Tether was backed by cash and other securities. So there's a question whether financial regulators should actually take care of this type of risks and oversee these behaviors of the issuers of stablecoins in financial markets. Is this a matter of financial regulation? Are those buyers of stablecoins users should be understood as financial consumers? That's another question that remains open. In the next slide, we are focusing on the Singaporean approach and how Singapore is responding to these challenges and this evolution in digital payments. First, we will talk about the initiatives, and secondly, the regulatory approach in the Payment Services Act. Regarding the initiatives, the Smart Nation initiative in Singapore, the Smart Nation strategy, includes a chapter on digital payments, and accordingly, Singapore has developed different alternatives and products associated with the evolution of digital payments, so people can use, for example, a unified QR code for payments in Singapore. Project UBIN, which is the initiative for central bank digital currency, started since 2016 in the country, and it had 5 phases, and now it has evolved to another initiative called Perdior, and this initiative is led by DBS, the Monetary Authority of Singapore, Temasek, and JP Morgan, and they are using what they learned in Project UBIN to enhance the issuance of central bank digital currencies for the efficiency in cross-border payments. And finally, the Monetary Authority of Singapore and Bank of Thailand, for example, launched the linkage of Singapore's Pay Now and Thailand PromptPay, which is a real-time way of making payments just using a phone number between the two countries. So Singapore has responded not only with regulatory frameworks, but also with specific initiatives that participate as other alternatives in the market of digital payments. Juan Ho is going to cover generally the scope of Singapore with regards to payments regulation, digital payments in particular, in the Payment Services Act. Juan Ho, the floor is yours.
Thank you. So thank you very much, Deborah, and my name is Juan Ho. So in this slide, I want to introduce to you what the latest developments in Singapore are relating to digital payments. So on this slide, the way I would bring you through this and bring you through the important points in Singapore is from the top left, you notice 3 blue boxes. And these are the licenses. It's a 3-tiered approach which Singapore has taken to the issuance of digital payment licenses. The simplest is the money changing license. Really, it's just a usual money changers license. But if you're doing anything from on the left, boxes A to F, if your business or operations deal with any of the activities in A to F, you will have to apply for what's called a standard payment institution license or a major payment institution license. The two are basically the same, but differ in the levels or the amounts involved. So I won't take you through the details. We can go through this in the Q&A, but really that's the 3-tiered approach, depending on the amounts involved and the services involved. On the box on the bottom left, you notice 4 common risks which the court, legislators have identified. These are concerns over interoperability, user protection, money laundering risk, and technology risk. So the legislature and the MAS central bank have actually come up with policies and laws in place. So we can discuss this in the Q&A session if you're interested. But what I really want to bring to you in the last minute or so is how advanced or how quick the legislature is to move in this. We've just had this Payment Services Act for just over a year, and there's already been an amendment bill that was tabled in November last year. And this is to respond to the FATF regulations newly promulgated in June 2019. So one really key point that I want to draw your attention to is how quick the legislation is moving in this area. And because of the various activities which my co-presenter Nydia mentioned on the previous slide, it's foreseeable that we're going to have a lot more changes to the legislative landscape. So with that, thank you very much for the time, and thank you to Deborah and the CIBEL team for having us. And I'll pass the time back to Deborah. Thank you.
Thank you very much, Nydia and Juan Ho, and also for your great timing on your presentation, which has been wonderful. We appreciate that because we want to leave time for questions. So our next speaker is Eunice Chua, who's the CEO of the Financial Industry Disputes Resolution Centre in Singapore. And She has more than 13 years experience in mediating, managing and adjudicating disputes. Before her appointment to this role, she was an assistant professor at the SMU Yongpeng House School of Law, and she remains a research fellow of the Singapore International Dispute Resolution Academy at the school. And she's had an illustrious career leading up to this point. So we look forward to hearing from Eunice. And Eunice, you have 10 minutes.
Thanks very much, Deborah, and the CIBEL team for having me. My presentation just gears a little bit, and we just focus on consumers here, you and me. How do digital currencies, digital payments affect us? And I approach this question from the perspective of effective dispute resolution, because that's what we at FIDREC over here do day to day. So on the next slide, I summarize the problem for consumers. Basically, you would see from this news article that consumers are vulnerable. And with digital payments and digital currencies, new opportunities arise for consumers to fall victims to scams, unauthorized transactions, fraud. And despite all the efforts from central banks, from other non-government organizations to educate consumers, we still see rising numbers of cases, a sharp spike, particularly in this pandemic year where many of us have pivoted to online payments. And this problem is not unique to Singapore, because the next slide also shows you some snippets of articles from other jurisdictions, like in the UK, where we had a pensioner, losing money to a spoofing scam, as well as in Australia, where it was observed in the Sydney Morning Herald not too long ago that COVID-19 had resulted in a spike in terms of scams and unauthorized transactions. So this is a problem for all of us all over the world. And the next slide, we look at whether there are any solutions to this problem. And I would observe at this stage that the law seems unable to offer an answer. So Kwan Ho was right earlier when he said that, the law is moving quickly relative to how it usually moves. But I would still say maybe not quick enough, especially where consumers are concerned. Because under the common law, I think that many will feel that the protection is with largely the financial institution because of the way that they can control the terms of the contract that consumers have to accept. So there is often little to no relief for most consumers under the common law. And in terms of regulation, if we look at different approaches internationally, we see great variance. So I'll go into some of these later in the next slide, but suffice to say now, we haven't struck on the right balance at the moment. Currently, the law tends to draw a distinction between authorized and unauthorized transactions. So authorized transactions will be those where you, the consumer, have signified your consent, maybe perhaps by way of keying in a one-time password, right? Or, clicking through a certain process. Whereas unauthorized transactions are sort of defined to be those transactions which have not been authorized in this technical manner. And I say this distinction is unforgiving because for the consumers who have been tricked, right, into giving authorizations, they fall in the bucket of having authorized a transaction even though they did not intend to. And in this circumstance, there is very little protection for them. Yeah. So in the next slide, I'll go into some of the approaches that some jurisdictions have taken on consumer protection. I'm starting with the EU, which is, I think, one of the jurisdictions that places most responsibility on financial institutions. In the EU Payment Services Directive, consumers will generally only be liable where they act fraudulently, right, or when they breach contractual obligations with intent or gross negligence. So I mentioned earlier that financial institutions have a bit of an advantage because they kind of control the terms of the contract, right? So I think to counter that, the EU has taken this approach, right? So where the consumer has not breached their obligations, for instance, consumers often have an obligation to safeguard their one-time password. Right? So if you breach that, you've fallen prey to a scam. Often the law was the contract will say liability shifts to you. You bear the responsibility. But the EU has gone against that, right? To say that, well, only if you breach with intent or gross negligence. So this, in some way, helps to ameliorate some of the distinction between authorized and unauthorized transactions. Another approach is the approach we have in Singapore. So Kuan Ho alluded to our Digital Payments Act. And under that act, we have various regulations, such as the e-payment user protection guideline, where Singapore has tried in its usual way to offer a nuanced approach to apportion liability so that there are circumstances where consumers may be liable for the whole loss, right? And this is where they have acted fraudulently or recklessly, or they're a part of the loss or none of the loss. So there is an effort to try to define the responsibilities of consumers and financial institutions to apportion the liability between the two. And the last model I offer here for contrast is the UK's voluntary contingent reimbursement model. So this model is interesting because it does put quite a lot of responsibility on the financial institutions, but unlike in the EU, this is voluntary. So the financial institutions can choose whether or not to agree, right, to this contingent reimbursement model. Under this model, all the consumers are presumed to, be able to get reimbursement unless there is some clear ground for attributing blame. But on the ground, we also see some reports that even this kind of a model is they may or may not achieve the aims that it sets out to, because although there are guidelines in place, it is easy for the bank to attribute blame to the consumer, given how we ourselves as consumers sometimes behave. We go to the next slide now. So the issues in practice in trying to find that right balance is, of course, moral hazard. The difficulty with the EU approach that has received pushback, particularly from financial institutions, is that there is some moral hazard there, because consumers, you do hold on to the OTP. You do have to protect your account. You can't really cast all of that onto the financial institution. So if we try to overly protect consumers, we also reduce the incentive for responsible consumer behavior. The challenge with the Singapore e-payment guidelines is that in trying to define responsibilities for consumers, sometimes we place unrealistic expectations on them. So how many of us, for example, have the most updated antivirus software installed in our computer? Have we updated it to the most recent version? So are such responsibilities reasonable? Should we ameliorate them? And then, of course, there's inconsistent industry practice, because different banks have different fraud protection standards. So it's impossible to say whether or not a bank has fallen short of the practice, because there is simply no standard. I'm working from home, sorry. So the hand you see appearing now and then is my young daughter. Okay, and just to continue, other issues are that difficulty of keeping up with the changing methodologies and sophistication of scammers. So however quickly, the law tries to change, we are always playing catch up. So that is a challenge in practice. And finally, the sense of fairness and reasonableness is, one of the things that institutions like mine, like the Australian Financial Complaints Authority, the UK Financial Ombudsman, they try to bring some balance because they introduced this concept of fairness and reasonableness, and they use that to try and shift the balance somewhat. But then again, this also presents a problem because it is inconsistent with the legal position as well. So again, there is that lack of clarity. So what do we need? And I come to my final slide here. What we need, clarity and consistency in regulation. I know this is easier to ask for than to actually, carry out in practice. But I mean, I have 10 minutes after all, so I'll just point to what is needed. Technological solutions. Just as we have developed these new digital payments and currencies, we can also develop solutions to detect fraud, detect unauthorized transactions. And finally, my area of interest here is mediation, right? In the face of uncertainty, in the face of regulation that might not be very clear in practice, or law that is very unfavorable and creates a sense of unfairness, well, mediation provides a solution, because if we can get both parties to take a sensible approach, everybody can move forward. And that is what we try to do at my institution, FIDREC. So I come to the end of my presentation. I'll hand the time back to Deborah.
Well, thank you very much, Eunice, and once again, I thank you for your timely response. We now move to our last speaker, who's Mr. James Mint from Herbert Smith Freehills, who's in Sydney. And once again, we thank Herbert Smith Freehills for their continuing contribution to CIBEL and the collaboration with their partners and lawyers, which enhances CIBEL's research so much. So James is the digital law lead for Australia and also heads the Digital Law Group's client and industry portfolio. He specialises in digital currencies and payments, distributed ledger technology and smart legal contract advisory. He's a highly experienced lawyer and has a structured finance and restructuring background with experience gained on cross-border transactions in New York and Australia, advising some of the world's largest funds, banks and companies. So his topic today is CBDCs and digital payment ecosystems. Thank you, James. You have 10 minutes.
Great, thanks everyone. Okay, so this is a difficult conversation to have because we ordinarily will spend about 5 hours presenting on this at Herbert Smith Freehills because there are so many layers of accounting, economic and legal concepts. We've been researching this topic for the last year because it's highly fascinating, huge developments. Clearly, China has banned the usage of cryptocurrencies, which has seen a 25% drop in markets. The Bank of England has announced that it's going to be releasing its key report on CBDCs midway this year. They already did an interim paper last year, and this morning, Asia time, the US Fed has said the same thing as well. So there's going to be a lot more discussion and actually finality around what major central banks are thinking around central bank digital currencies. So in terms of going through this presentation, could we go to the next slide? I am going to go as fast as possible. I think I'm actually going to be focusing mainly about the nature of money. What is central bank money? On top of that, we're going to focus on digital currencies and central bank digital currencies. And finally, what do CBDCs mean for digital payment systems? We know about Alipay, we know about WeChat Pay, we know about this whole area of banks and fintech growing around it. Are CBDs going to wipe them out? Or are CBDs going to be, DC is going to be under threat? So if a central bank issues digital currencies, how does it interact? And is there going to be a big change? And I'll try at the end to give a view. It might be controversial. They're all my thoughts, but happy to take questions at the end. So let's start. And I think the first question is actually, so the next slide, what is money? And this is actually a really tricky one. I've been researching this for a while, and I'm going to say something now which is actually not in agreement with what the IMF or the World Bank and actually most economists would say. So the traditional view, this is of course a £5 note. I spent a lot of time early this month looking at Singapore's currency, and also this is the Australian, it's hard to see, but it's the Australian $50 note. Now, if you look at the British pound, all British pound notes have certain words at the top which says, I promise to pay the bearer on demand the sum of X pounds. And I think that the general view of most people is that cash is a liability of the central bank. I think that one of the things I will say is I disagree with that. And the reason why is that ever since back in the day, reserve banks would actually, central banks would actually hold gold, and they'll hold silver, and they'll hold precious minerals, and they will back a currency. So if you actually brought up, say, a £5 note or a $50 Australian note or Singaporean note, reserve banks would actually have to meet that claim, that liability, with actual gold reserves. However, in the 1970s, there was actually a collapse of the Bretton Woods systems, and basically the US government said, we're not going to meet claims on notes with gold were out. People will trade in currency just because it is currency. And so you actually, if you go to the next slide, you actually get to this really interesting point where what is money? And money is actually, if you read the Singaporean notes and if you read the Australian notes, they say simply they don't construe it in terms of liabilities or debts or pay the bearer X amount. They say simply this is legal tender in Singapore or legal tender in Australia. And if you think about it, that makes a lot of sense, because if you had a $50 note, if that was a liability of the central bank of, say, Singapore, you go down to the Singapore Reserve Bank, what would they actually pay you in? They will just pay you in a $50 note. But so you basically have this self-recursive loop, which actually doesn't work from a legal perspective. And it's a really interesting thing, because I've been quite annoying to various partners across various law firms. Every time I've been negotiating them deals, I begin a conversation with, what is money? Is money a liability? And they've been very, very annoyed with me. But I'll say 50% say it's a liability, 50% of them say it's actually nothing, which is legal tender. And actually it's the latter, which is correct. And the reason why it's relevant is because it's actually going to lead into how do CBDCs actually work vis-a-vis digital payment systems. And what I like to think of it in a structured way, but effectively, there's different types of money. There's physical cash, which is public money, is central bank money. And then there's reserve accounts, which are digital monies. And then there's also commercial bank deposits. When most people think of money, they're thinking of the cash in hand, or they're also thinking about the money they have with commercial banks. The confusion that you actually have is that money held with commercial banks is a liability. It's a liability of the private bank, whereas money, cash, is not a liability to anyone. It's just legal tender. However, one important thing about currency is that there's actually the ability to convert physical cash to commercial bank or private money at par. So they're fully convertible. So there's a conflation where people believe that money is a debt. It is vis-a-vis the commercial banks, so private money it is, but not necessarily in terms of the central bank money, the cash. Reserve accounts are a completely different story. So I think we can move on from that. But what we actually have is that most developed economies, their money systems, and the reason why I'm focusing on the nature of money is we actually have a system, a financial ecosystem where you have central bank money. Could we move to the next slide? But we have central bank money, but it's actually intermediated by the private industry. So right now, putting aside all the technological companies, you actually have a situation where you have a central bank with the infrastructure of cash, and then you actually have it outsourcing a lot of the money services to banks. And so I think with the 2 minutes I have left, I guess what we actually have then is that when you actually move into the territory of digital payment systems and actually how will CBDCs, if a reserve bank or a central bank issues a central bank digital currencies, how does it actually interact? One point I will note is with new digital payment systems, one thing I will say is that the pre-existing structure of our financial payment system is the same, in the sense that you have the infrastructure which is set up by the central bank. You have, but then it has outsourced the function of that to banks. So I guess the challenge is then, if central banks move to central bank digital currencies, how does that interact with new digital payment providers? And I think it really depends, because if you read the statements of the Deputy Governor of the People's Bank of China, if you read the Bank of England's Deputy Governor's paper, if you read the Australian Central Bank, they propose a model which is a two-tier system. And the two-tier system works like this. The most likely, which is that the publicly circulated cash, so just physical cash, could be a central bank digital currency. But what they do lead out is that the majority of deposits can actually be done with the existing ecosystem of banks and tech providers. And I actually think that's the recommendation of the Deputy Governor of the PBOC, because the view is that you have cash, you have commercial bank deposits. Their view is that if they are going to implement a digital yuan, it's actually going to be a replacement for the cash. and it's not necessarily going to be a replacement for the commercial bank deposits, because if you think about the number of commercial bank deposits, it's actually going to cause a lot of problems, because are you saying that all customers can actually impose a liability against the central government? That causes a lot of, first of all, it crowds out the financial sector. Secondly, it means that the central bank is actually doing a lot more than just, to say, monetary policy. And so the proposal actually that's coming through is actually a hybrid model, which is that the physical cash, which is about 2-3% of actual currency, is most likely is possibly going to be replaced with a CBDC. And then they're going to leave it, because they've set up an infrastructure, they're going to leave it with private providers, which they're already doing right now with existing banks, to provide, Ali Pay, WeChat Pay, or other forms of tokens which fit in the existing system. So I think that's the model that's been moving. There is the more controversial and bigger idea, though, is if a central bank decided to say, we are actually going to, what we see on the screen right now, we are actually going to make cash and commercial bank deposits a fully centralized banking service. That becomes a lot more challenging. And I think from a big stakeholder groups, you can see like the banking industry, which is trillions, like $70 trillion. It'd be interesting how they will actually be effectively disintermediated from the entire financial process. So that's a very brief summary. I wish like each of these slides could probably be worth an hour each. Happy to take questions, and we'll love to continue the discussion. But I think that's it from me.
Well, thank you, James. And once again, I appreciate greatly. We appreciate greatly your compliance with the time requirement, and of course there was a lot more that you and all of our other speakers would have liked to have said, so possibly we can get you involved in something going forward. But we now have time for questions, and I've got a couple of questions so far, but if any of our audience members have any questions, could you please type them into the meeting chat functions. We have, I'm just checking, we have approximately 20 minutes for questions, so that's good. So I would ask the responders to please try and keep their answers shortish, but of course we want to hear what you have to say. So the first question I would ask is, someone has asked Eunice whether she sees the legal taxonomy of digital payment tokens as a challenge in terms of the use of mediation and dispute resolution.
Thanks for the question, Deborah. Yes, I think definitely the complex legal taxonomy for digital payment currencies will pose a challenge, because at the moment, this is quite a new area, and I think I'll also throw this question to James as well, because he's the lawyer here, right? But from the perspective of FIDREC, where I think of a consumer trying to find some kind of accountability, it poses a challenge in trying to find who it is I should be looking for, right? And I think the traditional financial institutions will kind of bear the brunt of consumer complaints here, because these are the institutions that are heavily regulated. And, for instance, in Singapore, all regulated financial institutions, they have to subscribe to an organization like FIDREC, where the consumer can come to us and have a free mediation process. And this is the same in Australia, UK, other jurisdictions. So for, those more, the creative up-and-coming fintechs and so on, those would be a challenge, because it would be very hard to look for them and find accountability for ordinary consumers. James, over to you.
Eunice, you're absolutely right. And it actually comes down to a concept which Ross mentioned, which is monetary sovereignty. And monetary sovereignty is each sovereign state's ability to control its legal tender. And I assure you, every country will come down hard on any other country or any other payment provider or bank that tries to impinge on monetary sovereignty. And so a really core part of that is regulation. For example, the Reserve Bank of Australia has basically unlimited powers in terms of banking. And so I think the comment about, new tokens and stable coins and new payment providers, a lot of them will be forced to comply, whether it's with KYC or other regulations, they will have to fit. The really interesting one, though, is truly decentralized currencies such as Bitcoin. Now, I would say that's probably going to be more challenging for them to actually succeed, because as we know with Bitcoin, you can use it as a unit of account, you can use it as a medium of exchange, but because it's so volatile, I do not see it actually replacing stable coins or other more consistent forms of technology and tokens to actually displace the existing banking system. And it's the latter category. For them to actually be fitting into the monetary sovereignty of a country, they will have to comply with the regulations.
I would just like to add there too, one can't see the banks going down without a fight, can one? They are so powerful in each of the jurisdictions. So I agree with what James has said, but in Australia, they are, to use Australia as an example, some of the largest corporations in our jurisdiction. I really can't see them losing too much of their market share or their position of power without a fight. Yeah. But thank you, Eunice and James. I have another question for all of you. What do we think that the impact of this will be on consumers? Who would like to answer that? And what I would say at the outset is, Eunice spoke particularly about scams, etc. In Australia, our ACCC, our Competition and Consumer Regulator, has a scam week where it publicises scams, and it works with an organisation called Scam Watch on that, and it's a really big thing. And as someone who has personally been scammed in online shopping, I would say, and foolishly, I would say that that's a very good thing. But what do people think about the impact of these changes on consumers, and who would like to answer this one?
I would like to jump in just to start the conversation on this important topic. For now, regulators, in terms of legal requirements applicable in this space, and particularly in digital payment tokens or cryptocurrencies, stable coins, etc., are taking this approach of preventing money laundering issues. But I think we should start internationally the conversation on how to pretend and what are the standards to protect consumers in this space. Who are we going to consider financial consumers in that regard, and have a standard internationally for it? This is going to be challenging because this type of services and this type of assets are being offered online to many countries, and consumers are not aware when they buy in the first stage of the transaction, when they get the crypto asset or the cryptocurrency, they're not aware that probably the issuer is not even incorporated in the jurisdiction where the consumer is, or the service provider that is facilitating the transaction is not licensed in that specific jurisdiction, but is probably located in a country that doesn't even have a regulatory framework to license those type of service providers. So that's an important conversation that I think regulators should have internationally in this in the payments committee of the Bank for International Settlements, for example, but we still need to take further steps on that. Hopefully we can contribute to the discussion from the academia, but policymaking has a lot to do in that regard still.
And I think from my point of view, and there's the research I've been doing in this area, it seems to me that that is one thing that is going to become much more apparent under CBDC and a digital stablecoin, is that we will not necessarily have such a uniform system as we've had in the past, because different jurisdictions are seeking different things from CBDC and stablecoin. and they're going to adopt methodologies which suit them. They're not going to be keen to fall into line and all do the same thing when they see an opportunity to adopt a different mechanism which will benefit them more. So does anyone else want to say anything on that question before we go further? I've got a few more questions here then, and I've got some. Okay, so here's a question to James. To James, what's the challenge you see when it comes to central government controlling the whole new money infrastructure, as the very concept of decentralised money was to take it away from the control of governments?
Yeah, that's a great question, and it is the fundamental heart of monetary sovereignty. There is a large part of the community who don't trust government, and that's part of, I think, the driver for cryptocurrency. But I think fundamentally, we think of it right now is that the whole financial ecosystem is heavily controlled by each government, and that touches on the themes of monetary sovereignty I mentioned before. No government will let that go. Now, in the context of, as I mentioned, like, digital payments and stablecoins, which would fit into the existing regulatory regime. I guess the question is, what about things like Bitcoin, which sit outside it, or Nano, or various other cryptos? And we've been researching heavily into basically every single blockchain and crypto out there. And I think the answer for that is theoretically yes, but there has basically been statements from the various central banks around the world where they've implied that we're aware of it, but for the reasons that we don't see them. We can see people moving to those cryptocurrencies, but it's unlikely that they will displace fiat currencies, whether it's central bank digital currencies or other commercially accepted currencies. They don't see it displacing it because of the volatility. Like, it's very hard to buy, despite what Elon Musk says, it is very hard to buy an Apple if your currency, your bank account, is fluctuating by 40% within a week. And so I think the question then is, because of that, I think then can you have it's a really good one. Can you actually have a decentralized stablecoin or another form of decentralized currency? And it starts going to very philosophical questions. What is money? If money is not a debt, as I started off with, and money is purely a social convention that people believe in, much like the law, we just believe in the law, or we just believe in nations, we just believe in money. If enough people believe that these decentralized currencies can take place, then I think that's actually going to be a huge challenge. And I actually suspect part of the reasons for the PBOC's crackdown on cryptocurrencies at the beginning of this week is for that recognition, which is that it is a threat to monetary sovereignty. And whilst the Western governments, like, we know we don't want to impinge on people's rights, I think if there is going to be that risk, they will step in, because an attack on the currency of a nation it actually undermines monetary fiscal policy and actually the ability of the government to govern. So I think the answer is that you'll probably see heavy regulation to stop it.
Thank you very much. That was a comprehensive answer. Does anyone else have any points to make on that question?
Totally agree. And actually, just to add what just James mentioned, the European Union in the digital finance package is included as one of the scenarios to develop in practice and deploy and launch in practice the central bank digital currency, the digital euro. This scenario that James was mentioning, feeling that foreign digital means of payment is displacing the local currency in that jurisdiction.
And we've got another question here, which is off on a different issue. Someone's asked what you think of China's pathway to CBDC and how is it different from the approaches of other jurisdictions? Who'd like to answer that one?
I can start, and I'll be quick. So I've been talking too much.
No, you haven't, and we've got plenty of time. It's plenty of time for everyone to have an answer to this if they wish to. So James, go to town.
Okay, there's two layers to this response. There's the one about just general policy, about privacy versus cutting down on illegal activity, and then there's one about the actual infrastructure of how it looks like. Now, Leo Tolstoy, you know, in like War and Peace, it's Anna Karenina says, like, you know, all happy families look the same. My view is that the ecosystem of all major developed countries, like China, they are going to pursue a two-tier hybrid model, and along the lines of, you, in terms of the structure, China and the US and BOE, even though the latter two are still tentative, are most likely going to have that the Reserve Bank or the central bank sets up the infrastructure. It may set up M0, which is the actual physical cash, but it will do what it's already done, which is to allow commercial banks and other providers to provide the bulk of deposits and other systems. So that's the hybrid model. You have CBDCs as the infrastructure run by the central bank, but there's a lot of movement in to having private parties do the rest, and you promote competition between. The other answer to this question, though, is, and I think this is the really interesting one, is how about social policy? And from, you know, the West is always very nervous about infringements on privacy, but then the countervailing concern, which is probably a legitimate one, is how about money laundering? How about criminal activity? If you have truly programmable money, which is trackable, now there's a question about tokens and accounts, but one of the expressly stated goals of the PBOC is that it wants to be able to track users' usage of currency. I actually think that that's actually going to be very problematic from say Americans or Australians to accept, just because of the culture. The EU has suggested a model where you actually have certain anonymous tokens, so that some small purchases can be completely anonymous. If you want to buy like something that's embarrassing to your spouse, you can do that, it's anonymous. But certain purchases, which I say over like $1 million, will actually be completely public, and the government can actually see it. Where that goes, I'm not sure, because, you know, you sort of have China at one end, US and Australia, and the EU in the middle. But I'll leave it there.
And it's interesting that you've raised that. I mean, in the visits I've made to China and where banking and privacy have been discussed, I've been quite struck by the really different approach of Chinese citizens and academics about privacy. They, and without generalising, and I've been in situations where this has been discussed a number of times, but anyone can please feel free to contradict me. People in China are far more inclined to allow some breaches of privacy where they think it's for the common good that would not be allowed in the West. And I found that quite marked. But if we don't get this information, speakers have said about, in the context particularly of digital platforms, these discussions were held. If we don't get that information, we won't know what's happening next. And I was quite struck by the sharp distinction between the approaches in the different jurisdictions. So I think that is, as James has underlined, I think that will be a real issue. But does anyone else have anything to say about China's CBDC pathway?
Perhaps I'll just one more comment, just to agree with you, Deborah and James, and coming back to the point that James made about how the topic is not just about, you know, the legal angle, but also there is this social contract, there's a philosophical element to what people can accept. And the way that, you know, China has been approaching the CBDC, I agree with James's observations that ultimately the central bank is still going to perform that role of central bank and allow the commercial players, right, to you know, innovate, to, you know, cater to the different groups of consumers and users. But ultimately, there's this culture, right, of Confucianism, and also, you know, there's also a political culture, right, that require, you know, that is very unique to China, that the other, you know, other countries don't necessarily face. Yeah, so just to add on to that.
So what we could end up, I mean, you may take issue with me, is a system where everything is done pretty much the way it's done today, but instead of using local currency, it will be done with everybody's CBDCs, with institutions operating in an extremely similar manner. I don't know if anyone's got any comments on that. Please say that you're wrong if you think I am. But I mean, I think that's a fairly strong option at the moment. And from the point of view of competition, because I'm primarily a competition lawyer, I think that that's very good. but I'll have a look and see if there are any other questions here. Sorry, I'm looking in the question chat and I'm having trouble. My chat won't move.
Deborah, maybe just to help you out, because I can see the questions too. We do have a question from Justin, who's asked about from the enforcement perspective.
Thank you.
In our experience, ultimately with enough digging, you can trace the digital asset to particular wallet. However, there is difficulty in linking the wallet to a legal entity. How can this be overcome? Yeah.
Thank you very much, Eunice.
Perhaps I can jump in and start the conversation on this topic, which is like the focus of most financial regulators right now in the Financial Action Task Force, how to identify people behind the wallets. Because interestingly, in some cases where a cryptocurrency was hacked, for example, Mt. Gox, it's well known that some authorities in some countries got the opportunity to trace where the Bitcoins ended up, in which wallet, but they weren't able to identify the person behind the wallet. So it's not very useful to know that information, even though the transactions are public in the network, because you don't have the identity of the person behind. The Financial Action Task Force since 2014 has been thinking of ways of promoting better standards internationally to identify the parties behind the transaction, the originator and the beneficiary. The focus for now is to put the burden, the regulatory burden, on the virtual asset service provider, which is the entity or the company that facilitates the transaction, that provides the infrastructure to buy or sell the cryptocurrencies or to transfer them to another wallet, and the wallet service provider that provides the service of custody of the private keys of the user. But there are many challenges for the industry in that approach. I think it's the correct one for now, but the challenges are associated with how these markets work. For example, in some jurisdictions, the OTC brokers are quite common, and these kind of advisors that just operate on behalf of other clients, and the crypto exchange is not able to identify those clients that are behind the OTC broker. They just identify the OTC broker. In other cases, the crypto exchange is able just to see the other crypto exchange interacting in the transaction, but not the client of that other crypto exchange. So probably the industry will need to have a conversation at some point, and they are starting in some jurisdictions with these associations of crypto exchanges and wallet service providers of how to come up with a way of cooperating between the industry to get that information and comply with these new regulatory requirements. But it's quite interesting, those developments, because they are quite similar to what is applicable today for cross-border payments in the financial services industry. I find that interesting in the developments of the cryptocurrency space, which started to be something so different and so apart from the traditional financial sector. But now in terms of compliance, it's quite similar, or at least that's where the international standards want to go for. I don't know if the other speakers think the same or find the same type of similarities on the approach.
Yeah, maybe I could add a couple of observations as well. My feeling is that traditionally you've seen white-collar crimes as being very fact-intensive. You can see prosecution teams stacking 10, even 20 prosecutors just to trace money around the world. The question is this going to change because you have a decentralized platform, for example, using Bitcoin or any of the digital payment tokens? And my feeling is that eventually technology gets to such a state where you come down to a few options. One is to have international cooperation. And this is probably the most extreme and anathema to many people who would go down a cryptocurrency route. They resist government intervention. But the more they push that way, the more they're forcing sometimes the hands of governments to join together. And this is what James alluded to earlier. It's a very, very big risk of money laundering, of criminal activity financing. And so that's one major way. You can see, one might see possible government cooperation, somewhat like tax evasion. You can see that happening in the tax space. The other is for a dedicated industry, white hat hackers. Really, you've got to neutralize the potential nefarious advantages that hackers might want to use. And that's a private initiative, really. You can see reasons why people want to invest in those white hat technologies, but you can see on the spectrum, full government cooperation as opposed to the other end, which is private intervention. So these are some challenges and potential ways forward, I think, for people to consider. Thank you.
Thank you very much, Kwon Ho. We have a question for Eunice from Christian, who says, are you aware of any legislative plans in Singapore to address the lack of clear rules on liability and cashless payment transactions? Will we see a more comprehensive Payment Services Act that will include private law issues and thereby go beyond its currently limited scope that only addresses public law aspects, mostly aspects of licensing?
Well, I think the indications are that yes, there is some ongoing work being done on this topic. And I think just from the past pattern of behavior, as Kwon Ho observed, the regulation in the payments services space is moving very, very quickly. So, Christian, I think, yes, we would expect some developments here. But I don't really have a lot of insight on what exactly might happen with that. Yeah.
Okay, we also have another question from Anonymous. Can the speakers comment on any distinctions which would make jurisdictions more willing to adopt access to wholesale digital currency more quickly, widely than retail CBDC?
I can answer that. Wholesale CBDCs are already here. So if you remember from my table, those reserve accounts, which every bank holds with the central bank, that's wholesale bank digital currency. It's in an account form, it's not tokenized, but it's a digital currency which records wholesale institutions amongst themselves. And as central bank, there's a question of whether the central bank performs purely a settlement role or whether it actually performs a creditor/debtor role in that. But fundamentally, it exists. And so the comment and statement which like CBDC experts like to say is like, a wholesale CBDC development will be evolutionary. It will just be a development of the existing systems, the reserve accounts. It's the retail CBDC which will be revolutionary. It's a nice way of saying it, but they exist. They're reserve accounts.
Thank you. We've got another question from Shubham. James, what is the challenge you see when it comes to central government controlling the whole new money infrastructure? As the very, I'm sorry, we've answered this one, I apologise. From the enforcement perspective, so this is to everyone, in our experience, ultimately with enough digging, you can trace the digital assets to particular wallets. However, there is difficulty in linking the wallet to a legal entity. How can this be overcome?
Deborah, I think we covered that one too.
Sorry?
We've covered that one.
Yeah, I think we have.
Answer that one.
Look, I've got a couple of questions because we're getting close to the end, and I'd like to give you each the opportunity to make some more comments. So what I'd like to ask you all is, who will be the first to have this all up and running? And in 5 years' time, where will we be on central bank digital currency? So I'm asking you to put your field glasses on, your thinking caps on. I don't know how I talk about it, but your binoculars, and look forward. And who will be first? And where will we all be in 5 years? So we might start with Nydia.
Okay, in 5 years, I think China probably is going to have to prove next year they have this strategy of taking the pilot to the next level during the Winter Olympics. I think so. In 2022, we will see if they will be the leading pilot in 5 years. Probably they will. How people are going to use it, how broadly it's going to be accepted as means of payments, I honestly think is going to be just another competitor in the digital payment space in that country. So it's not going to take or displace what the market share that some other private competitors and private offers already have in that market. I see 5 years is too short of a term to assess or see an implementation in practice in the European Union or in England or in the United States. Probably their pilots will take a lot more, and they will probably enter in a phase similar to what Singapore did since 2016, more exploratory, more just to test the technology, to have a proof of concept, to have the blueprint of the architecture that they want to have and their design of the central bank digital currency, but not a pilot that actually functions in practice.
Thank you very much. What about you, Eunice?
Well, I must say I'm not an expert as all of you are on this, but I thought I'll just focus on the dispute settlement perspective because it also picks up on, I think, one of the questions that was asking about the impact on CBDC and cryptocurrencies on the future of dispute settlement. So I think we have, Lydia mentioned China, and I think that China is very advanced in this respect. And we have a glimpse of the future of dispute settlement in China already, with their blockchain courts, that are technology courts that are very, very advanced. So how this might impact, law firms and businesses. So I think the asker of this question is probably more expert than me as well in this topic. And I think the points that are made as to the concerns about, will people stay away from CBDC due to concerns with privacy? I think yes. James already had covered, how some, the difference between a decentralized and centralized currency. So, there might be a future of development of even a decentralized CBDC in future, maybe, right? And in terms of businesses, whether businesses start accepting, digital currencies, well, we have, Tesla being one of the first examples here, stating that they will accept Bitcoin. Will other businesses follow? Perhaps, right? But I'm not sure whether anybody here is familiar with the developments in China on this, but I would be interested here if you know, what would be the prospect in China for this. But maybe not in 5 years, but in some future, we could be in a space where all of us, with our smartphones, paying digitally, we choose the digital currency of our choice. When we travel, it's seamless. You don't have to go to money changers. To me, that would be ideal.
Thanks, Eunice. What about James then?
Look, I think Nydia and Eunice have answered it perfectly. First of all, for those who are really interested, I take a look at Bahamas. So Nydia mentioned it before that they've already got a CBDC up and running. China will most likely be next. And it's actually worthwhile reading their papers and also the Bank of England papers because they really cover the concepts well. Eunice raises a really good question. It's the billion-dollar question. I think a lot of researchers would love to see what's happening in China. We see the output, but all the thinking. I wish I could speak Mandarin very well, and I wish I could fly on the wall in the PBOC meetings because they are so far ahead and they've thought through so many of the issues. I'm fundamentally just very excited about what's going to happen. I don't know what's going to happen in 5 years. I do agree with Nydia that it's especially with the EU, they took 10 years to get their privacy law, a uniform privacy law. It's 10 years or 9 years. So they'll be behind. I think Brexit is a really interesting one for the UK, whether they try to take advantage of that. But it's I'm a lawyer. I'm good at talking about what is there and what's in the past. I'm not sure what I can say in terms of the future without making a fool of myself. So I'll leave it at that and maybe pass it to Kwan Ho, who probably has a more nuanced response.
Thank you, Kwan Ho.
Thank you very much, and I hope I won't have the last one because there are more questions in the Q&A.
There are, but please, if you've got some more to add it.
Yeah, so these are, I would say in 5 years' time, I would come at it from a different perspective. I look at it from the development of the commercial law aspects in response to private law issues, because a lot of it, as one of the questionnaires, Christian has mentioned, what's in store for private law issues, as opposed to public law aspects such as licensing and regulatory mechanisms. The private law aspect, which is primarily my area of research, is that I have reservations about the extent to which courts can keep up with the developments in this area. You have, I would say, in the past, you had the feedback loop. You would have a creation of commerce or technology, and that would take time to mature. And over the years, you would gain experience, and the courts will understand, get to know and feel the technology, and then make a ruling and say, okay, this is property, or we can have a trust over this, or you can take back restitution of that asset. My concern is that these developments that we're talking about, and we have been talking about them for the past 5 years, have accelerated so far that ordinary courts, judges, even lawyers, such as our colleagues, may not fully understand the technology, the basics behind it. And what James mentioned is absolutely correct. To be a fly on the wall, I mean, right? To be a fly on the wall of policymakers and decision makers. So not to get a jump on them, but to understand really some of the aspects that go into a decision, so that at the downstream end, when we have to deal with the ramifications, the implications of things going awry, I think that part is the private law aspect between individuals and corporations and businesses, which has really yet to be worked out. And I'm not confident that we have that amount of time in the interim for people to get to learn about those things. So it may well be that we have to have a more cooperative approach. Legislators will have to be more cooperative and solicit the views of industry, technology, entrepreneurs to understand more, so that you get to a more robust regime. Instead of the courts feeling away about in the dark for the next 5 years, I think that's going to be untenable. That's my feeling, given the pace of developments in the technology space.
Thanks, Cornho. And one can only imagine how individual courts are going to deal with cross-jurisdictional issues in relation to all of this. It sounds like a real nightmare to me. And I think the issues about judges keeping up with it are just one part of it. So, yeah, that you've raised some really good issues. Look, at this point, despite the fact that we've got a few more questions, I think we'll close the discussion. I hope that the audience has enjoyed the presentations. I have particularly, and I would really like to thank our speakers for their excellent presentations and also their really interesting off-the-cuff answers to the questions that have been posed to them. And I'd also like to thank all of the attendees at this, this session for their interest and involvement. I'm sorry we couldn't answer all of the questions. Thank you very much to everyone, and also thank you to our CIBEL people, Fion and Wen and Hannah for facilitating this session, which went very smoothly. So thank you all once again, and don't forget that there's another session on shortly on similar issues if in fact you would like to attend. So thank you all and goodbye.